इसको पढ़ो, ठीक है। Friends, the budget, the most aftersought event for CA, and this time budget is really a balanced one. We thought that the budget would be. Let me hide everything so that I can hide video panel. Okay. Let me hide this video panel, and then I'll be able to move video panel, hide floating meeting control. Okay, now I don't want anything. Okay, I'm with you. Good evening, friends. This is C. Nitin Pathak. I am a chartered accountant by profession, and today I'm going to talk on in-depth analysis of direct tax. Generally, last time I would take in all the section what is possible. This time, as I'm leaving today for a week, so I did not get a time to finish every section, but I've covered so many things in this slide, so you'll be very pleased to have it. Okay, I am an immediate past president of ISACA chapter Ahmedabad. We ISACA chapter Ahmedabad promote CISA, CISM and other courses, and our aim is to have in Gujarat a lot of qualification for CISA and CISM and ISACA courses, so that all ISACA, all Gujarat is benefited because of this. It's a very specialized course. It has changed the way my life is. I wish you also do this setup of courses. With this, I go ahead. We are taking weekly every seminar. My blog is there at cnitinpathakblogspot.com, from where you can see so many things from the blog. So I wish you continue with us. Any query regarding income tax, any query regarding GST, just email us, WhatsApp us. Those who want to do CISA CISM are most welcome to us. We would be ready to support them. This is every Friday we are taking class. We are glad to announce that we are going to take every fortnight or weekly on GST, because GST has become a problematic thing for a businessman, because even small mistakes are really not pardonable. As in income tax, there are so many information with GST available with GST. So they are likely to be you are likely to be in big problem if you don't handle it properly. So we are going to have this thing in our mind. So any posers, you are most welcome here. Okay. And on 17th February 2023, Friday, 6:30 p.m., Shri Hiren Pathak and Nirav Shah is going to talk on latest amendment on GST. This is God Freedom Technique. The seminar is going to be God Freedom Technique is a technique which is given to Pradeep Mukherjee by messenger of a God. And there are different seminar available on this thing. And in my Facebook, my blog, there are write-up what the seminar is about is written. You can go and have it. This is wonderful seminar, which I wish many can do it. These are the types of past PPT which is available on blog. I wish say some of this like 194R, Daughter's Right on Intestate on Hindu Success and Property. Budget 2020 major changes which last year, Daughter's Right on Intestate Property, Cyber Security Myth versus Reality, Supreme Court judgment on inherent right of daughter under this Hindu Succession Act, PPT on startup, GST update on recent changes, annual, what is the AIS, cryptocurrency, Bitcoin, crypto bill, what is going to be the cryptocurrency at future market, NRA taxation in FEMA, analysis of budget last year, crypto digital decision. These are many, these are the only few I've said it, but many available on PPT. I'm going to talk on only highlight of the budget of the 2023. Okay. You can blog or question this PPT, this YouTube presentation, this PPT, I'll put it in my blog so that you can read it also. With this time in the budget, there are many far-reaching changes in charitable organization. There are 118 changes are there in budget. Budget is far-reaching changes this time. It's two huge changes. Application by charitable registration trust. What was happening in charitable organization? There are two things. One is income and expenditure account and a profit and loss account. And there is a corpus. There is an application of fund and source of fund. Until 31st March 2021, last 2 years, there was no concept of having a separate books of account. But from 2021, they have said that voluntary contribution is received under section 13(1)(c) with a specific direction should be kept as a VC, which would be a corpus of the trust. It should not be used by the day-to-day affairs of the company. And there is a concept called application of fund. Okay. So till then, suppose I give an example. In 2019, I have my 10 crore fund and I borrowed from bank 40 crore fund and I established a college. So my balance sheet side would say 50 crore, 10 crore, my asset side would be 50 crore college, 10 crore is my corpus, 40 crore is my loan from bank liability, which I have to pay, and 50 crore would be an application of fund which is out of source. So it would allow to be carried forward up to 31st March 21. But suddenly government realizes that people are not the way they should. So what they've changed the scheme, they have said that as soon as there's 40 crore, as soon as you make a repayment of a loan, it would be allowed as a deduction. So this 40 crore, how you will get it, how the trust is going to get it? It can get it either from a corpus fund which they receive or from a professional income, school, whatever running, that would be repaid. But suddenly they have changed the scheme. They said that 40 crore, as soon as the repayment is done, this would be allowed, not as an application of fund. So what has happened? Because what they thought, people are taking the charitable trust is organizing benefit twice. One once the application of fund and one at the time of repayment. So they change the scheme time and again. This time what change is made and what they thought is like 40 crore loan. How government IT department is going to organize? So they say that if the payment is not made within 5 years, this would not be allowable as a loan repayment. So after 4 years, if a school is run and is not able to repayment a loan of rupees 40 crore, So that 40 crore of the 20 crore they were able to make, 20 crore will become income, and they have to pay tax of around that, and they would be able to do. So this scheme has created a great mash. What was the mash? First carried forward of application fund is stopped. One repayment is stopped within 5 years. So these are the way that this trust is going to create a great difficulty. I tell you, really, in the event of say earthquake, in the event of eventuality, only charitable trust comes and gives the donation, and they do lot of charitable activity. It is why government is after charitable organization. We don't know, but when they are doing, they have their something in their mind. So we don't claim, but this is the real scenario today. The corpus, application of corpus, 40 crore loan prepayment within 5 years, application is not carried forward. These are the way the scheme is running. So regarding this, I've covered this here. Now, this I've already covered. Voluntary contribution made with a specific. Now you have to make 13(1). Even 30, the investment has to be made in under 11(5). There should be a separate books of account. Now, voluntary contribution received for the corpus of the trust cannot be used for day-to-day affairs of the company. So no carry forward, which I already covered in this. Now I'm going to next slide. So now I always charitable that IT department finds the way people are managing the affairs of the affairs of the trust. What they're doing, they have charitable trusts are allowed to use 85% of the balance fund available with them. So income 15% they can carry for, 85% they have to use it. Okay, once 85% they use, what they do, they give 100 out of 85, they go to B trust. B trust, whatever donation received by them, they give it to C to D. So by that whole sequence, they were saving 15% each time, and by that the application of fund was hampered. So government says that it's okay. Suppose you paid 100 rupees as a donation to A trust to a B trust, then it would be considered as 85 only. So to by that way, suppose B trust, so that if the trust gives a fund to some other donation trust, then to that extent 15% would be not applicable. So if that extra fund, they have to manage to make the backup of this. So are you clear? A, B, C. Now it is 100 rupees you give to a trust for other purpose, then it would be considered as 15 only. Charitable trust due to. Now what they're saying, when you want to file a form number 9, 8, 10, why you are filing the form? Just to avoid that, just to see that you are accumulating the fund. You are not going to use this fund for this year. So suppose in the 2031st March 2022, suppose now coming 23, now you are not going to use this. 1 second. 1 minute, I'm coming. I'm with you. Okay. Yeah. So as on 31st March 23, I'm going to file a form number 9 so that I can carry forward my 15% for a period of 5 years. Okay. So that period of 5 years, I have to file this 31st March 23, this form before 31st August 2023. Then I have to file the return, file the audit report before 30th September 2023, and then the final return before 31st October 2023. Suppose I don't file a form number 9A, then I will not be entitled for deduction under section 30, under section 9. I'm not allowed to carry forward. This is the scheme they have made because of this. And why these trustees are generally, most of the trusts I had seen, they are doing real charity. They don't have a proper accountant. They don't have a proper system. but still they are running because they don't have any mechanism to follow this. And there are two mechanisms by which the trust is on 10, 11, 12, 13, 12, AA, 12 is this thing, and section 20, 23C. Both are exactly the same scheme, but one is run as a trust, one is run as an institution. And if you don't, so even so, if you have filed form number 9 and 10, if you are not filed return under section 139(1), 139(4), but you file under section 139(8), then you will not be entitled to deduction. Okay, this is Jawaharlal Memorial Fund, Indira Gandhi Memorial Fund, Rajiv Gandhi Memorial Fund, which were entitled for 100% deduction, has been excluded from this time. Trust is a major thrust by the government. Registration of a trust. There was a previous registration of this. You automatically file this thing, provisional registration again. Before you commence the business, you just submit all forms, and you will be entitled for temporary. You have to submit all the paper before you start a trust activity. You have to apply for registration. Provisional registration was automatically granted on the basis of filing this return, but IT department realized that there are many insufficient information is given, incorrect information is given, false information given, resulting certificate granted to invalid disease. So that government has taken a power to revoke that temporary certificate also. So what is the provision? You have to file before starting an activity, by filing all the forms, and on the basis of that you will be granted certificate or not granted certificate. So this is provisional. I'm not going into detail, but only one thing, that the temporary and provisional has been restricted now. 115D. This is an horrible, with a very strange section. It's very important, but is it going to be a time testing? What is this? What is the section says? Accredited income. I give an example. Suppose one trust, one of my friend trust I'm filing, he has created a trust in 1980, and they have got 4 colleges, and all college buildings are in the name of the school. And because of certain reason, they are not able to, because now what has happened, because of school, some mismanagement, they failed to apply for registration of a for trust under 12A, 12A. Then what they say, if you fail to apply for the trust registration, it would be deemed to be a revocation, and on the basis of that, all this section would be applicable under section 115 TD. This is not the real purpose. It's very strange, but it is law. Always law should be as it is. The provision of tax accredited under section has been extended to trust. And if they fail to apply for re-registration, if you don't apply for re-registration, though you want to remain as a charitable activity, you don't want to make it a personal trust, but still if you don't apply, this section would be applicable. 115D of the income provides that trust is liable to additional income tax on the 115D of the Income Tax Act provides that the trust institution is liable to pay additional income tax on accredited income which arises on the conversion of trust into non-charitable form or transfer of asset of a charitable on its dissolution to a non-charitable organization. Until today, non-registration was not cornered into this, but now this would be the part of this scheme. It is proposed to insert, this time it is proposed to insert new clause subsection 3, new clause 3 in subsection 3 of the said accreditation provides that trust is registered under section 12AA, 12AB or approved under section 6, subclause 4 or subclause 4, subclause 4, 5 or 6 of subclause 6A of section 23 shall be deemed to be converted into from not eligible institution, not eligible or approved institution previous year if the specified person fails to make an application in accordance with the provisions of section 1 on the provision of clause 1, clause 2, clause 3 of the provision 1, 23C of section 20 or clause 1, subclause 2, subclause 3 of clause AC of subsection 1 of 12A within the period specified in the clause which expires of the previous year. Meaning of this complication section is that if you fail to apply or for the registration, it will be expired and then it will be deemed to be a registration revoked, and it would be assumed that your asset is being used for the purpose, and whatever, say for example, in our case, our 4 colleges are there. So we have bought all the schools and colleges at a price of say around 1 crore. Today its price is more than 2000 crore. So and not only that, its director has to, trustee has to pay the money. If the trustee is not payable, not able to pay, they would be liable personally. If further proposed, it is further proposed to amend clause 2 of subclause 5 of the said section, provide that principal of the trustee of the person is the case may be, shall also be liable to pay tax on uncredited to the credit of said within 14 days from the end of the previous year, in case referred to in this section. So clause 1 of expense of the sales to provide that date of conversion for on the date of last day of the previous year they failed to apply, it will be the date of registration. This amendment is effective from 1st April 2023, that is assessment year 23-24. So if any trust is not registered under up to 31st March 2024, they need to apply, otherwise they would be liable for this section 20 order. Now there is a Supreme Court judgment and order and one another judgment. On the basis of that, what was the judgment? Order is creating some commercial activity and make some profit. Because of that, certain tax liability may arise as per Supreme Court, and because of that, government has said that government has come with a new section 1046A. It is proposed to extend non-corporate entities such as bodies, authorities, board, trust, institution. So it covers all local authority, including Delhi DDA. All will be coming under this 1046A, established by State Act, Central Act, providing housing, planning, and urban development and regulating activity for the benefit of public. What this all the corporation has to do, they have to apply under Section 1046A. Arising to a body or authority or board of trust commission not being a company. The purpose of what are the purpose for which they are established? It has been established or constituted by central government, state government, with one or more of the following purpose, namely dealing with and satisfying the need of housing accommodation, planning, development, and improvement of cities, regulating this notified by the central government. I'm not going into detail, but in short, order has to register under section 1046A, and it has been notified by the central government and very shortly. So basically there are 5 major changes in charitable trust. 1, application of money, repayment of loan within 1 year, provisional registration. Then if you give a donation to other trust, it would be considered as not 100 but 85 only, and provisional registration is a must. Then application of fund, then provisional registration is a must. If you don't apply for trust, then it would be coming under 115 TD and 1046 with order. So there are major changes, and the due date of filing return, due date of filing form, and due date of filing audit report has been specifically made. If you don't do it in time, it will be gone. And they said that if you don't follow a TDS provision, you give a donation, you apply the money for section 33, any relative 10K, 10,000 से વધારે 10,000 से ज़्यादा पर्सनल खर्चा क्या केस में किया है, if these are the provision not followed, you are liable to your trust is liable to be revoked and your benefit may go. So these are the section. Now this is one of the most thought and discussed in a public forum about new regime and old regime. Government does not want old regime to continue. Government does not want unabsorbed allowances, any allowances, deduction, they don't want to give it. But anyhow, This is a year budget, election budget. Election is very near. So they have defined old regime and new regime. And who are benefited where is a really a dicey question. Each one has to calculate on their own. Only two parameters which is one to be discussed. Any business profession having individual, it would apply to individual, HUF, AOP, BOI, artificial individual person, and trust having an individual person. So these are the person would be applicable this new regime. And new regime is if you apply for it is automatically that you are in a regime 1. Old new regime is automatic. पहले क्या था? Old regime you are fixed. Because of these certain tax benefit are I'm not going to talk each and every time, but the slab is up to 0 to 3, 5 nil, 3 to 6, 5, 6 to 9, 50, 10, 9 to 12, 15, 12 to 15, 20, above 15, 30%. The surcharge rate has been reduced. So this is how I'm going. Next slide. So I'm going to talk about old new regime before, new regime now. First, it was up to 23, 24, it was approved individual HUF. Now it is applicable to so many persons, which I have already discussed. Now default is old regime. Now this what you have to, if you have to choose a old regime, you have to file a form. And when you're going an old regime, you have to give all proof of your deduction claimed by you. In this rebate under section 87A, up to rupees 5 lakh there is no tax. In new regime up to 7 under 24 25 up to 7 lakh there is no tax. 87A deduction. $12,500, now it is 25,000. Surcharge has been reduced from 37% to 25%. So anyone having income above 5 crore definitely would be having a tax advantage in the new scheme, mostly, not definitely. Okay. And previously, there was ATCCD, means Agnipath, and I say ATCC means deduction of a government employee under pension scheme. ATJJA was available, deduction in respect of for Agnipath scheme. So now these are old scheme. The new scheme, you are entitled for even standard deduction. In the new scheme with assessment year 24-25, you would be entitled for deduction under section 16A 50,000 for standard deduction. And if you are having a family pension you are receiving from under income from other sources of a relative, then you will be entitled under section 57(3)(a). This both will be available. Thus, now onwards, in case of new scheme, salary person would be entitled for section 50. Otherwise, no deduction is available under this scheme. So income from house property, HRA, LTA, investment in ETC will not be available under the new scheme. So up to 3,50,000, those people are entitled, may be benefited in old version scheme. But here one thing which I have already said, once the salary income is there and business income is not there, they are entitled to choose every time. They have an option to choose. But those who don't have any professional business income, once they choose new scheme, they cannot go to old. They can continue in old for so many years. But once you choose old to new, you cannot go back. This is old versus new, which is very high. I think I've covered most of the point. Who are benefited, who are not benefited, I'm not going to talk on that because each calculation would be individual one. One more scheme which is like MSME and presumptive accession. Previously, up to 31st March 23, 2 crore for MSME, 50 lakh for professional. The limit has been increased to 75, and for MSME it is increased to 3 lakh. In this new regime, in this new scheme, 3 crore and 75 lakh, there is one rider that not more than 5% of the total receipt should be by way of a check or the cash. If it is more than cash, you will not be entitled for this scheme. And here, check and cash 8% and 6% is minimum income exactly, and your expenses are less, then you should show more income. It is not minimum. It is minimum, but whatever you have deposited, otherwise it would be considered as cash credit and liable for the penalty. One must not forget this. MSME. To promote MSME, government is again once more use Section 43 clause H. What is MSME? Today, here there are two riders which I'm going to take it before I go to MSME. MSME, those who are registered under the portal are only entitled for MSME under this scheme. If MSME is not registered, as per Supreme Court judgment, those who are not registered will not be entitled for the benefit under section under MSME. MSME means micro and small undertaking. This MSME would be those who are registered in MSME is entitled to receive the payment for 45 days from the organization. If it is less than that, 15 days. If there is no agreement, if there is an agreement, it should be 45 days, but agreement cannot extend for more than 45 days. 15 days if there is no agreement from the date of bill. And one more thing, suppose I made a purchase from Reliance of 1 crore as on 1/4/2022. If I don't make a payment, if Reliance does not make a payment up to 31st March 2023, Reliance will not be entitled as deduction for purchase in their account. So he's in his account 43 section 43 H 1 crore non-make a payment to micro this thing would be added. And when he makes the payment, he would be entitled for deduction. Number one. Number two, if we don't have any agreement, we have an agreement of 45 days, and I made a purchase on 1st March 2023. And on the date of 31st March 23, as the due date is not made, this purchase should not be disallowed, even if I have not made a payment later on. If I have purchased, if I don't have an agreement and I have to make a payment within 15 days and I have not made a payment up to 31st March 23, then this would be disallowed. So 15 days on 31st March, this should be considered as on the last date of this thing. So if you look at MSME, the government's approach, government want to promote MSME so that they can grow, they can become a pioneer of these things. But many large organizations would try to avoid dealing with micro. If we get the same thing at same price from other than MSME. So this is also a possibility. But all things are go with the intention, not the result. Result is always a byproduct. They can change the law later on. Okay. One more thing. Previously, ULIP has been banned. More than 250,000. Any ULIP make payment, we're not entitled for this thing 1010D. One more thing. If I have taken a policy of 1 crore, and if I have to make a payment, say for 10 years, I have to make 15,000 per annum, then this 15,000 would not be entitled for this this under section 10DD. But now the scheme is further reduced. Even if my 1 crore policy, if I have to make a payment of say 5 lakh, still my limitation, they say that only rupees 5 lakh insurance premium would be entitled for deduction. Let me read verbatim. Where a premium of agreement is less than 5 lakh, it would be exempt under section 10D, and the premium policy does not exceed 10% of the sum assured. Where the premium or aggregate of premium is more than 5 lakh, any sum received which exceeds any where premium or aggregate of premium exceed rupees 5 crore or more in a year, any sum which exceeds the aggregate of premium paid in the terms of statutory chargeable under section 56 to 10. If the premium being claimed as a deduction and any other provision of the Act, premium will not be reduced from the sums of compensated manner. This any amount received on the death of the person, whether it is 5 lakh or more than 5 lakh, is exempt. I'm going into details with this also in this next slide. This section applies from 1/4/2023. If premium exceeds 5 lakh, 10% of assured premium. If I have a 3 premium policy, if I have after 1st April 2023, I bought a 2,50,000 3 policy. Out of 3, I have to choose 2, which is exempt. 1, I have to make a payment. 1, I have to make a part of money received over a period of time. Suppose 5 lakh exempt. I have paid 2,50,000. Now, as soon as the more money I have paid then received, suppose I have paid a premium for 10 years, 25 lakh, and I received 10 lakh, again I received 10 lakh, then again next year I get 30 lakh. So in the year of first receipt, second receipt, it would be my money paid to is deducted, and then when I receive 30 lakh, 5 lakh would be deducted, 5 would be deducted under income from other sources under section 56. Part of money is over a period of time. Any sum less than paid of tax from other sources. Life insurance taken before this, you leave 10% not taxable paid person earning. If I give you an example, suppose one person is a person who is earning and he paid the premium less than 5 lakh for say 7% in a house, that premium paid by him to others would be considered as a gift, and law of rule gift would be allowed. If it is a relative, it would be exempt. But for that person, he paid a policy, it will not be counted as in his scheme. Clear? 3 policy, 2 plus I paid for a policy, everything I have covered in insurance policy qua this thing. This is a under section 115 BAE. The manufacturing company were allowed 15% of tax rate for the person at the rate of 15% at the rate of surcharge for the assessment at 24-25 previously available. They said that cooperative should also be available. Here the limit is packed for new manufacturing cooperatives at 15%. One more really good cap by government. I give an example here. Capital gain on transfer of 14 crore. Amount capital gain on transfer amount is suppose I give an example. My house is of say 20 crore I sold. My cost of house is 1 crore. Indexation cost is 5 crore. I received 15 crore. And after 1/4/2023, I invested 10 lakh. So 15 minus take 5 crore. I invested 20 crore. But I would be entitled for 10 crore and 5 crore I have to pay tax on that. Okay, this is section 54. 54F. If the same case, if I have invested 54F, then I would be entitled for 20 divided by 14. The proportion would remain the same. Okay, so in that case, denominator would be total consideration, and under the total consideration divided by this multiplied by capital gain, multiplied by this total consideration. So here net consideration 5 crore, capital gain on transfer, these things. So the 54 and 54F, the calculation would be based on capital gain. So here the things would be different. Okay. Why this 54 have been done? Because many multinational companies shares the promoter sold, they earned a very huge amount, even house also. So they have restricted to 10 crore. So these are startup companies have made a huge money. And once the promoter sold the shares, the government income tax department come to know, they have restricted to 10 crore. It's a welcome this thing. So 54F, increasing the TCS limit on certain foreign exchange. So government wants Indian tourism and to be developed. So people are going abroad and they're having a tour package. Until now, they were paying 5% extra. Suppose I have gone abroad and I have bought a tour package of 1 crore. Previously, I have to pay 5%, now I have to pay 20%. Now, this is not restricted to this. Even other than this come, if I have to go abroad, previously there was a scheme if I have to transfer the money to my son for education or for housing or so whatever may be purpose. Until today, there was 5% of the amount of every amount in excess of 5 crore, 7 crore, 7 lakh. Now no limit is blank. Suppose I transfer my money from NRO to NRE abroad, then also 20% TCS will be deducted. So government, this is very, very, very like why they do it, I don't know. Government last year received $100 billion as in expatriate amount. So if government does like this, people, the expatriate would not like to send a fund here. But anyhow, this is government decision. This is a very, very draconian provision. 20% is a huge amount. The market linked debentures. Uh, you know what was happening in market linked security, market linked debenture. Market linked debentures where uh, people were buying and selling after 1 year, they would consider as a long term capital gain. And the government says that new section 50AA has been inserted, and anything contained in section clause 240A of or section 40A capital as a market linked debenture, the full value of consideration minus expenditure incurred would be considered as short term gain. They could have considered as an interest income also, but why they go like that, I don't know. But that is the frame of mind the government has it. What is market linked debenture? Market linked debenture is defined by SEBI. It is for the market linked to mean a security by whatever name code which was underlying the principal government in the form of debt security. If the return are linked with the market return or other underlying security, and include the security classified and regulated as such. So these are the definition which is given. Now listed debenture, until some of the debentures government say that we know who are getting what dividend, so we don't want TDS to be deducted. Now said no, from after 31st March 1/4/23, TDS will be deducted at the rate in force in clause 9 of section 193. That was exempting the dividend TDS to be deducted. Now they have to, the section is deleted. So now TDS is need to be deducted on interest on debentures. TDS generally should have been deducted on DTAA or TDS rate, whichever is lower. But now government has specifically provided in section 196A to see with the World Forum. I am not going into everything in detail, but on an average, this is the concept. So government previously changed the scheme as per section 9(1) subsection 8 of the Act provide that any sum exceeding with 50,000 received by NRI without consideration from a person resident in India after 5790 shall become a deemed to accrue NRI. Some of the erection is mentioned in section clause 17A of section 224. But now what I'm saying, so the gift is received outside India. As such, when gift is received outside, it is not liable for tax. So government has made a deeming fraction. Now, what were people were considering in non-resident, but they said income non-resident but not already would be exempt. Government said not like that. Government is any person, but person does not include a company and a foreign company. Thus, from 5th July 19, already person non-resident were liable for tax for any income received under income from other sources under this, with effect from 23. Resident but not already would also be liable for this section. prevention of this is a normal phenomena, but people were using, when I pay stamp duty, I claim a reduction under ETC, and now when I want to sell of shares, I would consider the cost of acquisition. When I buy a shop, I buy a income from a loan and I take it as an income. I claim it as a deduction as Section 24, and I am claiming both deduction, income as an expense as well as cost of acquisition. Government say that uh, prevention of double deduction on interest borrowed on for acquiring and reviewing on reconstructing the property with effect from Section 24-25. So this is just clarificatory, but it's very important. Extension of 55. We have a BC Srinivasan Sethi case. BC Srinivasan Sethi, in that case, the goodwill was exempt because goodwill has no cost. So this was an old judgment, and this is the Supreme Court. Government has started intangible asset, defining all intangible asset time and again. And on the basis of that, so many steps are covered. So government has introduced. So what basis Sethi was saying, there should be a capital asset to consider the capital gain. There should be a transfer, and there should be a cost of asset. What Section 55 says, even if there is a nil cost of asset, still it would be liable for capital gain. Okay. So now they have made a change in section. I have just verbatim put it from the bill. In Section 55, there will be the effect from 1st April. Subsection A in subsection 1, clause B, and in subclause 1, after the word goodwill, the word or in an intangible asset. So they have covered everything. And subsection 1 for the word profession or right, the word profession or any other intangible asset or a right shall be substituted. And for the word our or any other right shall be substituted. Meaning thereby, they have made so huge definition. Any intangible asset which is there would be concluded here. Say some of the example of adverse possession. I have acquired a possession. I am having possession, but by law of limitation, somebody, though I don't have a title, but nobody can remove me because of adverse possession. I'd be entered for industrial license, cooperative society bidding right, reconstruction of a cooperative society. These are example of certain right liable for considered as intangible asset. Nowadays, intangible asset is more valuable than tangible asset, and there are few things which are dicey. Suppose I get an excellent compensation, would it be considered as my right, alimony rights? These are the dicey issue which has been raised by someone. So again, I go back to that. The cost of an intangible asset shall be considered for which no consideration may be paid. Section 55, the income tax relating to adjusted or cost of employment provides that the section that defines expression cost of employment caused by the purpose of company, though nil, it would be liable for tax. However, there are certain assets like intangible asset or either right for which no consideration has been paid or acquisition. The transfer of result in generation of income could be converted to profit, but the cost of such asset will be nil. It is proposed to amend section insert intangible or any other right with effect from 1st April 2024. So now onwards, everything on the earth is covered under this section. Section 56(2)(7)(b) is amended to make it applicable share application money, share premium received from any person, regard of the residence status. Until now, only resident and ordinary were considered. But now, this angel tax will be levied for receipt of share application money, for premium, be it equity share or preference share, from anyone, would be liable for tax if company in which public are substantially interested. If the word resident is omitted, so now resident and non-resident both would be converted. the fair market value of the company would be considered, and the money received. The difference between fair market value and net consideration would be considered under section 56 to 7B. Now there is a valuation method. Sometimes when money comes from non-resident, there would be a valuation report would be also there of a mercantile because FEMA is also there. So they are taking care of that. But on an average, any money received extra fair market value, then net consideration, be it equity, be it preference, it would be liable for tax. The consideration received by closely held company for issue of shares that exceed the face value of such share. So this is a chart table I have prepared. The aggregate value of consideration for such share exceed the fair market value of shares determined under section 11 rule 11 UA. You go into UA, there is a absolutely formula is provided. Say what is the land price, market price, shares, stocks, everything is determined there. On the basis of that, it would be considered as income from other sources under section 56 to 7B. Any person resident in India up to before 31st March, by this will, it would be from irrespective of residence, it would be liable for tax. So previously it was resident, now it would be previously FEMA was taking care of this thing. Agnivir. Agnivir is a 4-year term by which Agnivir are taking a training in government organization. So this any receipt from Agnivir Trust by a person enrolled in the Agnivir 2022 shall be exempt under section 10(12)(c). A new deduction under section 80(c)(h) is proposed to be provided to individual who is enrolled under Agnipath after 1st November 2022. So there would be an employer contribution, there would be employee contribution. Employer contribution would be exempt under section 17. It would be taxable under section 17. Investment made under 80(c)(h), both employer and employee would be eligible for deduction under section 80(c)(h). At the time of maturity, any annuity received under section 23C would be allowed as exempt. So the scheme is called AEE. So Agnivir Fund section 17, 23 CEE and 80(c)(h) is covered. So one liner for this. Port Trust of India, a news agency which were distributed and dissemination of the news information. Now government says we don't need to have such type of this thing. So they have sunset clause from 1st April 2002. PTI will not be, in PTI and other few agencies were entitled for deduction. They said stop it. We don't need it. 43B. Certain 43B and 43. 43 means interest received by NBFC. Only available when you make a payment to NBFC. 43D. 43D. NBFC would be liable for income as interest income only in the year in which it is received. For that, the government would decide and give an official gazette, and on the official gazette, they would be giving these expenses. Last year, benefit of last year benefit of for non-tax benefit brought to tax. So it is proposed to clarify that. Oh, this is a very different provision. 194R 28. So when they brought this provision for the purpose of pharmaceutical company, they say that doctors and others are given a benefit qua medicine. Some they are taken outside, and on the basis of some receipt which they are received, 194R will be applicable, and it would be taxable under section 28(4). This was a provision. Now they find that if that TDS is not deduction, they would be liable to be prosecuted under section 276P. So 28(4) is at peak. But they say that now they introduce one more thing. 194R is applicable if the case or case partly in case, partly in kind. If any benefit is given under section 194I, the same will be available, same would be liable for TDS. One more thing which is coming to light. Suppose I have taken a loan from bank. Suppose ex businessman has taken a loan for 1000 crore. Now he knows that he is not able to make the payment, so he settled with the bank for 300 crore. So 700 crore. What is that? 700 crore would be liable for tax under section 28(4) or some other section, because because 700 crore liability ramification. So this would also be liable for tax this way. And these are the presumptive taxation 44BB, 44BBB, special provision in case of business or exploration, civil construction. They would be entitled for, they said that they will not be entitled for carry forward of losses or amps of depreciation. These are the provision with turnkey project. 35D. 35D, previously certain expenses were incurred, they are liable for 1/5 every year. Now government says that you have to file a form in prescribed form for preparation of feasibility, preparation of project report, market engineering survey with the permission of a board of director. They would be entitled for deduction under 35D if the form is filled. Joint development agreement. There was a joint development agreement between let me read it, then I would conclude here. 45(4)(a) of the income tax, there is a change. Section 5 said that it provide that capital gain arising to an SSE from the transfer of capital being land, building, or both under a specific agreement, the capital gain shall be chargeable to income tax or previous year in which the certificate of completion is received. They include that this cash payment or any check payment, whatever may be, will be included for the purpose of that, in consideration of which it is proposed to include consider received by cash, by check or draft or any other mode shall be deemed to be full value of consideration as a result of the transfer. So generally cash transaction doesn't come here, but they said any transaction would be included here. TDS non-liability of winning lottery up to 23, 24, 25, assessment 24, 25. Any income tax earned by winning from online game were liable at 30%. The tax at 30% will be kind of net winning from online during the previous year. Now they say that suppose someone has entered into online gaming. So when he entered and when he exit, when or at the end of the financial year, suppose I invested 1 lakh in the gaming zone and I withdraw 2 lakh on 31st December 2022. Say 1/4/22, 31st March 23. So 2 lakh, 1 lakh I have deposited, 2 lakh I have withdrawn. So 1 lakh would be a capital gain. And at the end of the, suppose I don't withdraw, and I don't withdraw till the end of the 31st March 23, and my balance was 8 lakh. 1 lakh minus 8 lakh, 7 lakh would be taxable at the end of the financial year at the rate prescribed there. Okay, this is 194BA, TDS or net winning online game after with effect from 1/7/2023. I think I've concluded in a very precise way. This budget is so huge. Anyone wants to make me question me, they can mail me directly. I'll answer them. Right now, I have so much thing pending, so I'll go ahead with this. Okay, whatever coming, so I will go fast. One second, I'm just hiding the panel. Okay. So TDS on payment of equivalent employee. Previously there was 10% and 10%. Now government says 10%, and if you don't provide the maximum margin, the government said no, 20% is enough. Those who doesn't provide a PAN number in case of EPF. Proposed amendment in the threshold limit of 194. So any society, cooperative society dealing with the members, the limit is extended from 1 crore to 3 crore. This apply to even repayment also. The TCS, overseas, which I've already covered 5 to 20. TDS winning online covered. Listed exemption is also covered. 197 is proposed to amend 190 will be scope. The unit holder receiving the income from business trust can obtain so lower tax deduction is allowed to be taken to section 206AB, 206CCA have been amended to exclude certain person from those who are required to file a return and notified by the government, which is already covered. For certain non-resident foreign company, TDS will be taken at 20% or rate specified in tax rate. So nowadays they say that if you are covered in DTAA, the same would be applicable. Uh, this was a really benevolent section. What was happening that I have paid I have shown my salary as income, but my employer has not deducted TDS. I have to pay tax. Now what they say, you may pay tax, but at the end of the year in which he has made a payment, within 2 years from that, you can apply and claim the refund. While claiming the refund, one thing is to be considered that under section 244A, the day on which you apply for TDS refund, till the you receive will be entitled. Otherwise, it will not be entitled. Section 155 is amended to solve the TDS mismatch problem. When a taxpayer reported income using accrual method, it may be taxed before the TDS is deducted. It causes a TDS mismatch. The amendment allows the assessing officer within 2 years from the final which the tax has been withheld. The assessing official then amend 244A will be applicable. The proposal is to set off and calculate the definite strategic. This is applicable for IDBA, which is going to come in a public issue. I'm not going into 72A because it's a mechanical project. Proposal carry for accumulation in case of amalgamated banking company के लिए ये है. ATIC एलिजिबल स्टार्टअप में जो इशू होता था पहले 10 साल था उसको एक्सटेंड करके 7 ईयर कर दिया 7 से 10 कर दिया इवन इफ देयर इज अ चेंज इन द होल्डिंग ATIC eligible startup will be able to set off carried forward losses incurred during first 10 of income even if there has been a change in the shareholding as long as shareholder continued during the relevant period. Search and survey. So there had been a lot of survey and search, and for that, some of the cases, genuine difficulty was there. So I would go through. So the time limit has been extended, and sometimes the search conclusion date is used to conclude the date. Just I'm going through the fast. I will be covering fast, but you will be this slide would be available, so you will be able to get it from that. Time limit for completion of any pending assessment or proposed assessment is 12 months. Where the search is initiated as section 132A. 132A or 132 requisition made. The extension shall be applicable for the assets being searched and to whom any seals or requisition money bullion jewelry these things are found in their possession. The amendment proposed to section 132 allows an authorized officer to receive assistance because what is happening when the person goes to the place, there are certain places it is very difficult to find where the goods are, something in cloud. They have said that they can have digital expert, they can have blacksmith, whatever may be. They have given all power, but with the permission of principal CCIT. This is genuine need of a time. Someone is putting something in cupboard, you will not be able to know it. So for that they need an expert. It says so there is an Apple phone. If you go and you cannot open the Apple phone, but now if some cloud franchisee, then they would be able to open that and use it. And these are the facility being provided, not only police, but these are the facilities also. The timeline for completing the assessment or reassessment in such cases are linked to the execution of last authorization. So they would start with last authorization. The timeliness of completing assessment or reassessment in such cases are linked to the execution of the last of authorization during the search case. It is proposed to provide the meaning of execution of under section 132. So search and survey, these are the things. To avail Some of those to avail the section 10 double A before you need to file a return, otherwise you will not be entitled to benefit. This is a very specific instruction given. Transformation of gold into e-gold into that with a permission intangible as high. The cost it is proposed the transaction physical gold. I intangible asset I've already covered here. I don't go into that. Income distributed from offshore derivative instrument ODA with offshore fund. These are the specific provision for GIFT City and IFSC City. This offshore fund is being handled from GIFT IFSC center, and if this is handled, then the distribution of income, any distribution, this will not be chargeable to tax in the range of 1158D. I'm not going into detail, but this is available on this thing. So now SFA is collecting the information. When the SFA is collecting information, sometimes the information is wrong. So what they say, the establishment, financial establishment would be liable to pay the penalty of 5,000 for submitting the wrong information, incorrect information. Suppose one is a customer of HDFC. He provides the wrong information, and the same is submitted to under SFT. What they say, penalty has to be paid by HDFC, and they would be in turn be able to collect it from the account holder. It is proposed to amend section 271C and 271 to provide penalty for procedure where deductor failed to deduct ensure tax 194S, RS and 194, which I've already talked this thing. Government at the announcement stage say that there would be lot of decriminalization of this section under section 276A. But when it comes to reality, it was only one, and only for liquidator, that's also for reduction of TDS. But he is liable to penalty. The SSC can file an appeal. This is an appeal provision which was left. Now one can file an appeal, one can file a cross objection. A few appeal would be because there is a lot of backlog. So Commissioner CAT appeal would give some of the appeals to Joint Commissioner to unburden the burden. The deadline every year there is a change in the timeline period. The deadline of complete scrutiny assessment is being extended for 12 months, 9 months to 12 months. There is a cost audit in case of assessing officer think that the valuation is undervalued. Undervalue also can be checked out, and this thing return in response to notice under previously there was a notice when previously we were writing my last return may be considered as a final return, but they said that this provision is related, now you're mandatory supposed to file return. They are giving 3 months time, and before 3 months you have to file the return. So this is a new provision. You are mandatory supposed to file a return, though there are certain judgment which says that you need not file a revised return, you need to file a return only. So you can say that my old return can be considered as the fresh return, but be it may, we recommend to file a return. Specified authority for granting approval for issuance of notice under section 148 in A, PCIT, DCCT, if it is more than 3 years. So in short, Chief CIT, DG, Principal CIT, DGT can give a specific authority for issuance notice if it is beyond 3 years under section 148 and 148A. In certain cases, 15 days additional time is allowed. The provision of strain capitalization double deduction in case of 24. So which I've already covered. Once you are claiming as deduction, you are not entitled for that. Startup 1 year increase. Startup 1 year. The proposed amendment in section 92D shorten the deadline for submitting. So when in the case of assessment at the time of transfer pricing, they said that 30 days has been reduced to 10 days, but it can be extended another 10 days. This is a provision for giving less time to TTAA. Certain provisions are deleted. ATC, CCD, 8454, EA, B, C, D, E, 11A has been deleted. IFSC has given an authority to so many things. which I am not going into details. Central government prescribe a uniform. They are planning to have some uniform code distributed of business trust. Here there is a business trust. They have got asset. They've got a capital. They've got a borrowed fund. Out of borrowed fund, they make a payment. The payment would be considered as income. Cancellation and क्या बोलते हैं, sudden redemption would be considered as taxable. But once the original price would be there, would be available for that. So business trust itself is a very dicey issue. But I've covered in one line. Once, because you borrow and give it as a dividend, as a this thing, but still it would be, there is a distribution. But when we borrow and distribute, it will be considered as income. These are business trust issue which is coming. The just income tax refund. They have taken a power that if I have a refund and there is some assessment is going on under 143 1A or 143 or someone, they have got a power to withhold this thing, or because whatever happen, I may not get interest on the, or I may get less refund on the interest withdrawn, and when liability comes, I have to pay on that. So this is something which is a dicey one, but this is the law as it may be. In the case of pending assessment, we return reasons also to be withholding the refund. Additional interest on refund will not be payable. Primary agriculture society, primary agriculture March has been 2 lakh to 2 lakh. The increased limit to 2 lakh, which I already covered. 92BA is amended to transaction between cooperative society and other person in purview of this. 9 amended to gift, which I already covered. It is proposed to amend. It is proposed 151. These are the things. 151. Who is authorized to do what? Is under 148. 148. This I already discussed, but here it is taken as an authority. 256 amended to ease the backlog of CAT, which I already covered. The power to delegate, the power is delegated to DCAT. It is further inserted the provision of this thing. IFC location I already covered. Thank you very much. Many other PPT is available on our blog, Nitin.Pathak.blogspot.com. My email address Nitin.Pathak. This thing. Anyone who wants to give a call, somebody can unmute and ask me any question he wants it. With this, I am concluding. Thank you very much for patience hearing. I have covered so many things that's in a very short period of time. Anything else? Anyone want to ask a question? Just mail me, I'd answer it. And see you on 17th on the subject of in-depth analysis of GST. Some of the provision will be considered. Hello.